Welcome to the deep dive. We're here to take on those really complex topics, like a dense financial report, and just make them clear. Forget getting lost in the numbers. Our mission is simple. Give you the shortcut to being properly informed. We pull out the key insights, maybe a surprising fact or two, and hopefully have a bit of fun doing it. Today, we are diving deep into Recursion Pharmaceuticals, that's ticker RXRX, specifically their Q2 2025 earnings. And this deep dive, it's tailored just for you, so you walk away really understanding what's going on.
Exactly. And we're using our five-part framework to guide us. We've pulled together Recursion's official press release, real-time market data, and what analysts are saying. Think of it like connecting the dots for you.
Right. So by the time we're done, you'll have a solid handle on RXRX's performance, their strategy, and what these numbers actually mean. Not just the what, but the why behind it all. Now for slide 1, the at-a-glance scorecard. Let's kick things off with the big picture view. How did Recursion do in Q2 compared to what Wall Street was expecting?
It's kind of a mixed bag, actually. It really is. And it's, pretty typical for a growth stage biotech. The headline here is definitely the revenue beat. That's a big positive for a company pouring everything into future discovery, even if, well, profitability wasn't quite there.
Okay, break that down for us. What were the numbers?
Sure. So total revenue came in at $19.22 million for the quarter. Now, the estimates were quite a bit lower. Zacks had it around $14.4 million. Others maybe $15.4 to $15.7 million. So, yeah, a pretty significant beat on that top line. The money coming in.
There's always a but, isn't there?
Well, yes. When you look at the bottom line, the diluted net loss per share, how much they lost for each share, was reported at $0.41. Analysts were hoping for something closer to 35 cents. So revenue beat, yes, but a miss on the earnings per share, or rather loss per share.
Okay, so revenue beat, EPS miss. How did the market react? Because I saw the stock actually jumped.
Yeah, exactly. In pre-market trading on August 5th, RXRX shares were up around 6.2%. It's fascinating, isn't it? It suggests investors, right now at least, are really prioritizing that top-line growth and the strategic partnerships over these new-term profit concerns.
So the partnerships are key. What was the general feeling from analysts?
It was pretty mixed, reflecting that reality. Lots of positive comments on the strong revenue, and especially that milestone payment from Sanofi. We'll get into that. But, that was balanced by definite concerns, the widening net loss, the significant cash burn, and the fact that they clearly need ongoing capital. The market's just betting on the long game for now.
Okay, let's unpack this. Here's a look at the core financial numbers themselves. Let's do the year-over-year comparison.
Right, so comparing Q2 2025 to Q2 2024, total revenue, as we said, up 33.3% from $14.42 million to $19.22 million. Good growth there. But net loss widened quite a bit, from about $97.5 million to nearly $172 million. That's a 76.2% increase in the loss.
76%. But wait, you said the loss per share barely moved.
Exactly. Diluted EPS, or loss per share, went from $0.4141 or ments, only a 2.5% increase.
Okay, here's where it gets really interesting. How can the total net loss balloon by over 76%, but the loss per share only nudges up 2.5%? That feels counterintuitive.
It does, but it points directly to a key mechanism: shareholder dilution. Think of it like this. You have a pie representing the company's loss. That pie got 76% bigger. But at the same time, the company cut that pie into way more slices.
Ah, okay, so each slice didn't get that much bigger, relatively speaking.
Precisely. The number of weighted average diluted shares outstanding, basically all of the potential slices of the pie, it surged by a massive 72.3%. From 242 million shares to over 417 million shares. So that much larger total loss was spread across many, many more shares. Mathematically, it keeps the per-share loss looking relatively stable.
So for an investor, that means the company is funding itself by issuing more stock, watering down existing ownership.
That's the trade-off, yes. And the market's positive reaction tells us that, for now, investors seem okay with that dilution. They see it as necessary fuel for the growth engine and those strategic goals.
Moving to slide 2. The engine of profitability. Okay, with that scorecard view done, let's dive into the costs. For a clinical stage biotech like Recursion, profitability isn't really about current profit, right? It's more about strategic spending and burn rate.
Exactly right. You look at these margins and think, wow, that's bad. But actually, it's expected. It's not a flaw in the model at this stage. It's a feature of their heavy investment strategy. So gross margin was negative. Their direct costs, $20.16 million, were actually higher than their revenue of $19.22 million. Operating margin, hugely negative, around minus 917%, because the loss from operations was about $176 million. And net margin, similarly, around minus 894%, reflecting that $172 million net loss. These numbers just scream, we are investing heavily for the future.
And it sounds like the main driver for that widening net loss was a big jump in operating expenses, especially R&D, is that right? And why are R&D costs climbing so fast?
Absolutely. R&D is the big story here. Expenses surged 74% year over year. That's from roughly $74 million in Q2 last year to nearly $129 million this Q2. That one line item accounts for most of the increased spending.
And the why? What's behind that 74% jump?
It really boils down to two major strategic initiatives. First, that collaboration with Tempus. It included a $22.7 million non-cash expense just for access to Tempus's data. Think of it as buying puzzle pieces of really valuable biological data. Second, the ongoing integration costs and activities related to the business combination with Exscientia, which closed late last year. This isn't just about specific drugs, it's about building their core platform, the Recursion OS.
The Recursion OS, their tech moat, essentially.
That's how they frame it, yeah. It's their AI-powered system designed to make drug discovery and development faster and hopefully more successful. It's a foundational investment.
Okay, and what about the other operating costs, G&A?
General and administrative G&A also rose quite a bit, up 47% year over year, from about $32 million to nearly $47 million. A lot of that is just the natural effect of scaling the organization to absorb Exscientia and support the overall growth. They need more infrastructure, more people. It's also worth just noting quickly the press release didn't give us non-GAAP figures this time. Those often adjust for non-cash items like that Tempus data expense, so they might have shown a slightly different picture of the underlying cash burn.
Now for slide 3. The engine room business segment performance. Okay, so they're investing heavily. Let's look at where the value is being created. We can think about Recursion having two main engines, right? Partnerships and their own internal drug pipeline.
That's a great way to look at it. Engine 1. Partnerships and collaboration revenue.
Yeah.
As we saw, total revenue, mostly from these deals, grew 33.3% to $19.22 million. And this isn't just about the money, though that's important. It's huge external validation when big pharma companies sign on.
Any specific updates on those partnerships?
Yes, some key ones. That Sanofi payment we mentioned, $7 million for an immunology program hitting a milestone. And what's really significant is that's the fourth partnered program to hit a major discovery milestone in just 18 months. Each of those programs has the potential for over $300 million in future milestone payments alone.
Wow, fourth program. That does suggest the platform is delivering.
It certainly helps the case. Then with Roche and Genentech, they reported meaningful progress. They're building this enormous phenomap in neuroscience using data from over 1 trillion cells, apparently, and a GI oncology program is moving along. With Bayer, the focus is on precision oncology, tackling targets previously considered undruggable, and the Merck-KGaA collaboration in oncology and immunology is ongoing too.
So these partnerships bring in cash that isn't dilutive, doesn't involve issuing new shares, and they validate the tech. That's crucial, like you said.
Absolutely crucial. But engine number 2 is where the potentially massive long-term value lies. Their internal clinical pipeline, the drugs they own outright. This includes several oncology programs, REC-1245, REC-32565, REC-3565, REC-773,000, and a couple in rare diseases, RB-4881 and REC-102.
And what's the latest news there? Any key milestones coming up that we should watch for?
Yes, they give a pretty clear timeline. For REC-1245, they're refining patient selection, and we expect early phase 1 safety and pharmacokinetic PK, how the drug behaves in the body data in the first half of 2026. For REC-617, they've started enrolling patients in a combination therapy trial for ovarian cancer, and we should see more monotherapy data in the second half of this year, 2025. An interesting move with REC-102, they acquired full rights from a joint venture, and they're aiming to start phase 1 in the second half of 2026. And then additional data for REC-4881 is expected later this year, and early data for REC-3565 sometime in the second half of 2026.
So a lot happening across the pipeline.
Definitely. This pipeline represents the company's really big bet. Each of those data readouts you just heard is a potential value inflection point, a moment where things could significantly change up or down based on the results.
Moving to slide 4, financial strength and shareholder rewards. All right, pipelines and partnerships cost money. A lot of money in this case. Let's shift to Recursion's financial health. How strong is their balance sheet? Can they actually fund this ambitious strategy?
Well, let's look at the cash. As of June 30th, 2025, they had $533.8 million in cash, cash equivalents, and restricted cash. That is down from $603 million at the end of 2024, so you can see the burn rate is significant.
Okay, $533 million. But management said their cash runway extends into Q4 2027. How does that square with the burn rate we talked about? That seems like a long time.
Yeah, that's the million-dollar, or rather $100 million question. You're right to flag that potential discrepancy. If you look at their cash used just in operations for the first half of 2025, it was about $208 million. Double that for a rough annual figure, you get around $417 million burned per year. Simple math, $533 million cash divided by $417 million burn suggests maybe 1.3 years of runway, not out to late 2027.
So what's the catch? Are they expecting miracles?
Not miracles, but they are implicitly forecasting successful execution on bringing in more cash. Their guidance factors in assumptions. Specifically, they're banking on hitting those partnership milestones, potentially over $100 million worth by the end of 2026. And crucially, they assume continued access to the capital markets.
Meaning issuing more shares.
Most likely, yes. They just did a $100 million share issuance in June through their at-the-market or ATM facility. That lets them sell shares directly into the market more discreetly. So that runway guidance into late 2027 is really a statement of confidence that they can execute on partnerships and can continue to raise money when needed. It's contingent.
Got it. Contingent is the key word there. What about debt?
Debt levels are pretty low, actually. Their debt-to-equity ratio is about 0.42. That's calculated from $383 million in total liabilities versus about $919 million in stockholders' equity. It shows they're primarily financed by equity, not debt, which is healthy and pretty standard for a biotech that isn't generating product revenue yet. Less fixed burden.
Okay, and shifting slightly shareholder rewards. For a company like Recursion, pouring every dollar back into R&D, how do shareholders get rewarded? No dividends, no buybacks.
Correct. No dividends, no buybacks. All capital goes back into the business. That's the norm here. The reward isn't cash today. It's the potential for significant share price appreciation in the future if their platform and pipeline succeed.
But the flip side of that coin is the dilution we talked about earlier.
Exactly. That 72.3% increase in shares outstanding year over year. That is the cost existing shareholders are paying. You own a smaller percentage of the company today. The expected reward is that your smaller slice will be of a much, much larger pie down the road, making your investment worth significantly more. It's a classic growth stock gamble.
Finally, slide 5. The road ahead management's outlook and key takeaways. All right, let's pull this all together. What's management saying about the future, and what are the absolute key things you need to take away from this quarter?
Well, CEO Chris Gibson really hammered home the message about the Recursion OS. He emphasized its ability to not just discover drugs, but also to understand patient populations better, which he believes accelerates the whole pipeline, both early and later stage programs. And the Chief R&D Officer, Dr. Najat Khan, gave some concrete examples. She mentioned REC-1245 being identified through their Phenomap insights and how they used AI modeling on multi-omic and patient data to pick the right cancer type for REC-617's combination trial.
So trying to show that AI is actually making a difference in decisions.
Precisely, showing the tech biothesis in action. And they reiterated that clear timeline of upcoming milestones we discussed earlier. Just to recap quickly, later this year, more data on REC-4881 and REC-617. First half of 2026, early data for REC-1245. Second half of 2026, early data for REC-3565, and starting the trial for REC-102. Plus, that potential for over $100 million in partner milestones by the end of 2026. It gives investors very specific things to watch.
Okay, so boiling it all down, what are the main takeaways? If someone only remembers a few things from this quarter, what should they be?
I think there are 4 key points that really capture the essence of Q2 for Recursion. First, a tale of 2 metrics sparked a positive reaction. The market clearly focused on the big plus 33.3% revenue beat, driven by that Sanofi payment, sending the stock up 6%, even though EPS was a miss and the net loss jumped 76%. Growth trumped profit this time.
Okay, number 1, market liked the revenue beat.
Second, investing aggressively to build a technological moat. That huge increase in losses, it was deliberate. They spent big in acquiring data from Tempus and capabilities from Exscientia, causing that 74% R&D surge, all to strengthen their core Recursion OS.
Number 2, big spending is strategic, building the platform.
Third, dilution is the fuel for the growth engine. Why did the loss per share barely move despite the huge jump in total loss? Because of a massive plus 72.3% increase in shares. Dilution is how they're funding this ambition, and investors seem to accept it for now.
Number 3, dilution is keeping the EPS loss stable, and it's the cost of growth.
And finally, fourth, the cash runway is a forecast, not a guarantee. That guidance into late 2027 isn't based purely on cash in the bank. It hinges on hitting over $100 million in milestones and likely raising more capital, given the high cash burn. It's a projection with dependencies.
Number 4, runway guidance depends on future cash inflows. Got it. So ultimately, Recursion's Q2 really highlights their whole tech bio strategy, doesn't it? It's all about these strategic trade-offs, giving up profit now, accepting dilution, all for this really bold attempt to build a foundational tech platform they believe will pay off massively in the long run. It's quite the balancing act.
It really is.
Yeah.
And using a structured approach like this to break down the earnings, well, it helps any investor get past just the headlines, right?
Yeah.
You start to see the why behind the numbers, the strategy at play. It's a process you can use again and again to stay informed.
And that's what we aim for, giving you that shortcut to being truly well-informed about Recursion. Now, just the necessary reminders. Please remember, this report is for informational purposes only. It doesn't constitute financial, investment, legal, or tax advice. All investment decisions should always be made based on your own research and in consultation with a qualified financial professional. Also, just be aware this report was generated by an artificial intelligence model, integrating data from official sources and public market data. While we strive for accuracy, errors or omissions can occur, so please independently verify any information before making decisions. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.